Welcome on UBP TV. Equity markets were more volatile and less trendy than expected since the beginning of this year. There are four main reasons to that. First, the US economy is not doing as well as expected. That is due to the weather. That's why we are expecting a sharp reacceleration of the US economy going forward. And that is also the main risk to our scenario. If the US economy is not reaccelerating, that will probably have an impact on our asset allocation. The second reason is earnings revisions. They were quite weak. It's linked to the economic situation. For example, in the US, for the first quarter, expected earnings growth has come down to 2% for the first quarter from 6.5%. The third reason is China. The economic activity is much weaker than expected there. They're trying to implement reforms to change their business model and to tackle corruption, pollution, and speculation there. So that is at the expense of growth, and that's why for the first quarter, probably in China, we're going to get a GDP growth lower than 7%. And the fourth reason is the situation in Ukraine. It put a lot of pressure, especially on European markets. But here things are going a little bit better because, for example, the Russian equity market is sharply up since 2 weeks. The ruble is strengthening and credit spreads are going lower. So it's improving at least, and it's not a cap anymore for European markets and markets in general. So on the positive side, we can see that risk appetite remains elevated. The main reason is on the credit market. We see that high yield spreads, corporate spreads in general, remain very tight at low levels, and that's a very good sign. On emerging markets, spreads have stabilized as well. And on the European periphery, which is one of our theme, on the bond market as well, we saw a lot of interest, and spreads against Germany are still going down, which is very good news. So there are reasons to expect that the markets could resume their march higher, especially if the economy is improving, which is our main scenario. So we're going to look at that very closely. That's why for this month we haven't changed our asset allocation. It remains unchanged. We still have a bias toward the risky assets and equities in particular. Generally, we think that emerging equity markets will underperform equity developed markets. There are two main reasons for that. First, commodity prices, except maybe for soft commodities, but commodity prices will remain under pressure for the next few years. Why? Because marginal demand is going down, thanks mainly to China. And secondly, supply is going up. So the mix is not very good for commodity prices, and a lot of emerging countries are relying for their economy on higher prices for commodities. But that is a plus for the global economy and the world economy in general. The second reason, which is not very good for emerging markets, is the fact that we are currently seeing a relocation of production. Thanks to new technologies like automation, robotics, and additive manufacturing, companies have the possibility to produce close to their customer. So that's a very good trend for developed markets, but it's not a good trend for emerging markets. Therefore, the long-term relative performance of emerging markets should be disappointing. But on the very short term, the next few weeks, we could see a rally in emerging market. They could, because the sentiment is very low, they could outperform developed markets for the next few weeks. Thank you for your attention.